Hello, everybody. You're so welcome here to the Crunch My Numbers podcast. And in today's episode, we're going to be talking about something that I believe is not talked about often enough, but it's about planning. And if you know me, you'll know I love talking about planning and execution, but planning is a big part of it. But today I want to open with a statement, and it is most people overestimate what they can do in 1 year and underestimate what they can achieve in 3 to 5 years. So, what we're talking about in this context today is tax planning and having some kind of a framework around your tax planning, and what would a framework look like and how would you use it, and why is a framework really important in the context of tax planning. And for me, and the medium term tax plan that we should be looking at, the basic medium term is 3 years. And why 3 years? Because everybody kind of addresses their tax and addresses their tax planning in a 1 year cycle. So you'll go in, you'll sit down with your accountant, you'll have your tax return prepared. That tax return will be done probably around the end of October, November, submit it to the revenue, and job is done. But it doesn't really give you much of a chance to really and truly plan how to minimize your effective tax payments, but look at other things that you might be looking at in terms of your long life cycle to do with overall financial planning. And for me, that 3 years is kind of the sweet spot, because you have the previous year's tax to look at, you have the current year's tax to do, and then you have next year's tax. That's one version of the 3 year cycle. And then also we have current year and 2 years ahead. So that 3 year cycle really blends really, really well in terms of sequence and context and making tax decisions and making really smart tax decisions. And this is what we're trying to do. We're trying to get business owners into the mindset of how can we use tax as an asset within our business. I know that sounds strange, but how can we use tax planning as an asset in our business? And for us, we have built our tax smart planning grid, and this grid covers the 3 year cycle. And what's included in it? It covers all elements and alignment of all the tax elements that you would be normally looking at on a relatively short to medium term. And those are things like, we use a word called bridge, and the bridge covers business sale timing. It covers retirement and pension integration into your overall tax planning. It covers income planning, and we'll go into these in a little bit more detail. It covers dividend strategies. It covers things like gifting and trust efficiencies. It covers exit and asset disposal. Just the word bridge, we'll be able to build everything in. And if we're talking about things like business sale timing, but this is a once in a lifetime thing we do. So if people say, well, it's time enough to look at that in 3 to 5 years' time. I'm money young, I'm not doing it. And I'm always saying you need to look at that today and have a really detailed and a really comprehensive plan around that, so that when this thing happens and when you're getting to that stage, you've a well planned for. And the reason we do this is to maximize the reliefs and the business readiness. They're two very distinct things, but they're two very, very important things. If you maximize your reliefs in terms of business sale timing, this has a huge, huge impact on your overall wealth and your overall effective tax rate. And remember, what I'm talking about effective tax rate as a business owner, if we're in a company, we pay corporation tax, we pay personal income tax, we pay USC, we pay all the tax charges that are relevant to all areas of a business. And business owners tend to deal with probably 80% of the taxes that are out there in the Irish economy or in the UK economy. So for timing and effective tax rate, so if I'm paying money over to the government or the HMRC, it doesn't really matter to me if it's income tax, if it's corporation tax, it's still tax and it's still going into the government coffers. So what I'm trying to do is make sure that I pay the appropriate amount of tax, but use the benefits and the reliefs that are there for us on a regular basis. How would you go about looking at that? Well, things like retirement relief, business sale relief, all of those things we've talked about on previous episodes, but they're all relevant when you're looking at this tax smart planning grid. So albeit it's a once in a lifetime thing, it should form part of your thought process and always keep it in the back of your mind. And the effective tax rate means that if you use the benefits of corporation tax, income tax, pension planning, and other tax planning, the amount of money that you pay over out of your total income, profits in the company and your own income, will be substantially reduced legally and in the right format and in the right methodologies. The next thing is retirement and pension integrations. Now, what I want to talk about here is the tax planning on retirement. And retirement, I believe, as a business owner, retirement planning and pension integration should always form part of a good, healthy tax plan because the benefits are huge to do with the tax relief on the pension contributions. And there's different reliefs, whether you're a personal or a director, and then you have the company can make payments. And that's changing down the line very rapidly now in Ireland as well over here. But also in the UK, there's also their own regulations to do with the pension. So understanding the regulations and building your connected advice team is really important in this. But mapping out pension contributions over 3 years, why is that a good idea? Because number one, cash flow and liquidity. That's really, really important. So cash flow and liquidity in your business drives everything. So you need to have the cash flow to plan it out. And in terms of making pension payments, it is always better, and history will tell us, that if you're making payments every month, you will get a lot better return than if you're making, once-off payment, a lump sum into the market in general terms. And the reason that is because you're buying units at this month, next month, and the price varies each time. It's called euro or pound cost averaging. So when you go in there and put the money in there, you will get a better return if you're buying a little bit every month. And eventually, over the long period of time, that will aggregate and that will make a huge difference to the long-term return if you have a long-term planning strategy. So cash flow is huge. Using all your reliefs. Make sure you're maximizing your reliefs and what you're allowed to pay cash flow within your pension fund. The next thing is planning your income. And how should we plan our income? And we should plan our income based on what our personal requirements are. So that's the first thing. What's our family spending? What's our family costs? What do we need to budget for our own income? That's the first basis of this. And then personally, how can we put money away for, kids' education or whatever else we're on to put, family holidays, wherever it is. So the income planning is a huge part of it. And then understanding what allowances we need and what future cash we need to build up in our own personal capacity to pay off things like mortgages or just to have your own personal savings plan. So when we understand that, we need to spend time planning that. And it's not, I need to pay this bill today. We take the money out of the company, we pay the tax on it. It's inefficient because it's inefficient and it's burdensome on the company as well. Just in terms of the cash element, but also in terms of the planning and the payroll element, all that. It's just when it's not planned out, it becomes a little bit more haphazard. And people tend, in that haphazard nature, when they don't have a budget, to take out a lot more than they actually need. If you look back on the years, you'll sometimes end up having paid a lot more in tax by not planning it. The next thing I want to talk about is dividend strategy. And I'm talking about two different jurisdictions here now. I'm talking about the UK and I'm talking about Ireland. In Ireland, dividend strategy is not the number one strategy when we're looking at, from a company perspective, to take dividends out of your company to pay as part of your salary. It can be used, and it can be used in particular circumstances. But in general, we don't tend to take the dividends out of the company because of the tax rate that's on them, and the company pays the tax, and then we have to pay the benefit. We pay up on that. UK is different because they're allowed a tax-free element within the dividend as it forms a very good and serious part of their tax planning. Gifting and tax efficiencies within gifting and trusts. Again, we've two separate things in trusts. They're used a lot more in the UK, and they're not used as much in Ireland because of rules to do with the trust. But gifting in Ireland, we have this annual allowance we can gift, and it's a really good way of planning an annual basis, giving that gift to somebody to build up money for child, grandchildren, whatever your education, whatever you want. And it's a really good way of using up or extending the use of inheritance tax planning. So gifting is a really big, big part of it. And then the last part of the bridge comes to E, which is exit and asset disposal. When should we dispose of property? When should we dispose of shares? Other assets, how are we going to smooth out our tax exposure and protect our long-term goals? So tax exposure is always something that needs to be planned, not, as I said, not on just come in and do your tax return. This is a longer approach. It's a more connected approach. It's a better approach because people themselves will, when they understand that they're not just dealing with today's tax return that can have no effect on it because it's in arrears, they're now starting to look ahead. Well, I can do this and I can do this. And this is really, really important. Why does this matter is another really, really big point for 4 reasons. The first reason is it bridges silos. So tax planning is usually siloed just by the tax advisor and is kept there. But if you get all your advisors working on the same plan, you have your pension advisor, you have your tax advisor, you have your accountant, all those three people working on the same plan has, 3 to 4, maybe 5x of a better return, because it's about you, it's about your plan, and it's not just one person doing your tax and forgetting about it. The other thing, and this is a thing that as long as I'm working here, this is the number one thing that our clients don't like: surprises. They absolutely abhor unexpected or large tax bills coming at them where they don't know what about it. Their dates are clashing with income tax payments, CGT payments, pension payments, and there's nobody's informed on this, and you come to the year end and you have a big tax bill, and then how am I going to pay the tax bill? And it's very, very frustrating, and it's very difficult. So the reduction of surprises with the clients, that's to do with timing of returns as well, but the reduction of those are really, really important, of the surprises. Now, there's also good surprise if you get a tax rebate, but that can be planned in advance as well. And optimizing your timing is really important. So when you're going to exit, you can't exit really efficiently if you're going to exit tomorrow. You have to plan it. Again, having that 3-year look back 1 year, look forward next year, and you're in the current year, and then this year and 2 years ahead. Really good behaviors, good exposure, good planning, and it gives you this confidence that you're getting the right advice, but it also gives you the confidence that you're doing the right thing. And then the last part of why it matters, because it aligns with your goals. Tax isn't about saving money. It's about aligning wealth, family, and lifestyle. It's about getting the three of them lined up into one line. What do I need for my home? What's my lifestyle like? How do I want to live my life? How do I want to plan this part? And tax is a part that we really need to, it's there. Everybody pays it in all forms, direct and indirect tax. So we can't avoid this, but we can plan this. So for me, like when I'm looking at the bridge part, right, and just look at tax for us, the first part of it. When we look at the business sale and the dividend strategy and the income, that's a big part of the tax side of it. But wealth becomes a big part of this as well when we're looking at building pensions and gifting gradually. That helps with your wealth generation and your wealth creation. The other part is the lifestyle, and that's really important as well. So maintaining your income flow, that you have a steady flow of income, maintaining this buffer that you have cash if you want to go off to Australia for 5 weeks or something like that, or if you want to, whatever you want to do, having that buffer is really important. And then for retirement and travel and holidays and all that. The word bridge is important because we bridge tax, wealth, family, compounding, positivity. All of this stuff really comes together, and it's really, really, it gives people this kind of a security blanket wrapped around them. That's a big, big thing. So again, I just want to finish up with saying most people overestimate what they can do. As I started with this, and I'm going to more or less finish with this, what they can do in 1 year, and underestimate what they can do in 2 to 3 years. So think about that concept and think about how can you make it better? How can you plan better? How can you make sure that you're availing of whatever you need to avail of within tax, in the strategy of tax, within the use of exemptions and relief. And remember, tax is about wealth, life, and cash flow. They're the three big areas that it covers. Thank you so much, and I hope you enjoyed this episode.